Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today.
Good afternoon. We're actually on the road today, so I'm broadcasting from Oslo. I want to welcome everyone. For those of you that have rejoined our sessions before, if you want to pose a question, type it in the lower right-hand corner. If you want to send someone a private message, please just move your mouse over the photo of the person or the name, and a window will pop up about allowing you to make a private message. There are 3 emojis to clap, laugh, or if you think something is brilliant. And if you're desperate to join the panel, just click on the microphone next to your name. I'll get a signal to grab your mic, and your screen will be added if I let you in. So I am thrilled today because we have Clara Miller, who official title President Emerita from the FBA Heron, but at the same time, she's one of the most prolific gadflies in the whole sustainable investment space, a thought leader, a writer, an activist, and she's one of the first people to integrate sustainability into a major endowment. Clara, thank you so much for doing this. For those of the audience that are from a different planet and don't know who you are, I'm going to go on mute and just give us a little bit of your story, who you are, what you're doing now, and how you see the ESG industry developing.
Sure, and thank you, Robert. I'm honored and happy to be here. And I keep asking myself the same question, who am I and how did I end up nattering about sustainability accounting at this stage in my career? So I will go back to the beginning. I was not the beginning, but my 2 kind of fundamental experiences that are relevant here, I think, is I was the founder of something called the Nonprofit Finance Fund, which was a community development financial institution that focused on difficult to finance nonprofits, social enterprises, et cetera, in the U.S. We worked with banks. We did financing with banks. We did all sorts of things, and basically looked at abandoned markets. And I got a lot of experience in how finance does and doesn't work as a tool, what happens inside banks that excludes and includes people. And also, I learned about the story that financial statements can tell, the lessons of comparisons with enterprises, because that's what one does if you're trying to put money on the street. And the power of data and stories together. When I was at Heron, we had a saying, no stories without data, no data without stories. And the idea that actually finance, of course, is a social construct. It is not a natural law that anybody can change. And along the way, the social and emotional makeup of markets, which we are experiencing every day, all day. So that was, and the nonprofit finance fund grew over when we started, we had, something like finally raised $300,000 or something. Seemed like a massive amount of money in 1980. And then when we ended, we had done a lot of social sector finance, and I think we were at about maybe 150 million in assets, both on and off book, and had done a tremendous amount of financing, working with foundations and others all over the states. So, that was sort of the in the trenches background. And then I became the Heron Foundation president. Heron Foundation, well before I arrived, was a leader in putting more and more of its permanent capital endowment, whatever you want to call it, on the street in alignment with its mission, up and down the market, whether it was public company stocks, private equity, didn't matter, all of those things. And when I arrived, it was about 40% alignment with mission. And it was just after the financial crisis, a couple of years after the financial crisis. And we had to, we, of course, as foundations will do, we did a little strategic planning. I know as a person who raised money from foundations, the 13 most terrifying words are, we have a new president and we're going to do strategic planning. That's what foundations say. But we tried to make it quick and do it all in-house. And we concluded that, well, we were very, very proud that our portfolio, the CDFI part of our portfolio, was the best performing asset in our endowment during the financial crisis without any exceptions. It sailed along 4%, ticking over. And so we thought, wow, we're great. And then we said to ourselves, gee, fine, we have this cute little terrarium in which everything is wonderful. But outside the walls, in the economy in the US, the financial crisis led to the greatest stripping of assets from the poor in American history and middle class. And if your mission is to help people in communities help themselves out of poverty, you're not doing something right, or you need to keep pushing. You can't be proud of yourself. So anyway, we said, well, why stop at 40? Let's align 100% of our capital. And then, we're a $300 million foundation on a good day. We have to make sure we're pushing outside our walls to change systems so that they don't have the effect that the financial crisis had, as huge and ridiculous as that goal might sound. So we started by aligning 100% of our capital for mission. We looked into our crystal ball and found that there were some bad surprises in our own portfolio. And we started to try to, say, well, rate companies in public companies, because we knew, weirdly, they're big. They employ a lot of people. Even if we can have perfect examples of great enterprises that we're doing good work with in our grants and PRI and other parts of our portfolio, we can't change the economy without having a conversation, at least being an investor, having whatever leverage we might have in these huge behemoths in the economy. So we looked into our portfolio, and then we managed to find out that the MSCI data that was used in the ratings was laughable. I mean, even as a studio art major, I could tell that having a policy that hiring women was a good idea and checking a box for that did not mean that you were hiring women or people of color or you name it. And there were various other, findings that these data that are the foundational part of the ratings were in need of becoming more rigorous, put it that way. So that led to my interest in accounting, because I thought, that this is, and we hitched up with the Sustainability Accounting Standards Board, and the rest is sort of history, which was establishing data standards on environmental, social, and governance topics, yes, ESG, for public company reporting. Okay.
What year was that? What year was that?
2012, maybe. And that's 10 years ago now. It's incredible. And, that was about doing data standards that were similar to, or that were kind of based on, the data standards for financial reporting by public companies. And it's, I think, I had this idea that, this financial accounting happened in Italy in the Renaissance or whatever, it had been around forever and there were data standards and there was all this stuff. Well, actually, it was 1973, I think, that FASB, or the Financial Accounting Standards Board, became real in the States. And so these were industry group, they were comparable, they were about material, they were all these kind of things that connected them to the current infrastructure of the markets for these public companies. And we had a couple of ex-SEC commissioners on the SASB board who basically said, or chairs of the SEC, who said, they're required by law to be reporting on ESG topics that are material now, on environmental, social, and these supposedly externalities to their operations, but they're not, or they are, but there's no comparability, there's no transparency, the data standards are all over the place, they can't be audited, et cetera, et cetera. So that was that push. It was about changing that particular little part of the system. And that's what I thought ESG is. And that's what I still think ESG is. So when you say, ESG is a problem, and, I thought it was actually kind of a compliment that Elon Musk called it like the devil's spawn or something like that. I think it's about changing the nature of the system. It's not an either or kind of thing. Yes, ESG and impact and broader accounting standards. And, we don't have time to be either or, sequentially, orderly, linearly develop something or other that's going to be better. We have to do it all at once. It's a mess, and we're going to have to just continually innovate and sort that out. So the idea of those standards, as their performance, they're the performance of enterprises. And if you think about it, enterprises are one piece, but they're probably doing the heavy lifting for climate change, to stop climate change. It's not going to, and it's going to probably be big enterprises doing that heavy lifting of changing themselves fast enough to have a real impact in the near term. And I don't think, I wish we had I wish we could do it all over again. I can go back to my misspent youth and, we could be listening to the folks that I listened to then and seem to be on the right track, but that's not an option right now. So these are standards that allow us to figure out whether enterprises are adding to or detracting from extraction of society's capital or adding to society's capital. And we can't measure that if we don't have a baseline. And the baseline now exists in financial accounting and in those SEC rules for public companies. It's one part of the system, but not the whole system, as we know. And so they're by industry vertical also, which I think is important because it means that those industries can compare themselves to peers. And depending on another system, which is the rules surrounding them, the larger kind of collective, if you will, they can start to go up the performance curve. But they won't do it unless there's there's a carbon tax, or there's some sort of carbon regulation, or we're following the example that it looks like the Europeans are going toward, and others. So that's only one piece of the puzzle. And you can have positive or negative performance, just like in finance. It's, compare it to financial accounting. If you think we shouldn't have financial accounting, then, we have something to talk about. But if you compare it to financial accounting, positive or negative changes over time. The market or the infrastructure of the market has something to say about whether about whether you're succeeding or not. And hopefully, you attract or get or do not have access to capital based on those things. Then there's ESG, and then there's impact, and people say, well, I'm for impact, but I'm not for ESG. I'm not for fraud. So I think that, if we look at the way companies are using the term ESG, then we have a lot to talk about, because there's some fraudulent players out there. But that has more to do with not having accounting standards that are about environmental, social, and governance topics than it has to do about having them. So yes, ESG, but let's not pretend that that's the end of the conversation. It's just a way to provide baseline and rules for hopefully improvement over time. And right now, we don't have any way to measure it as a society. So then, the tools of finance are really the tools of social change. And it's not, they're a social construct. And they have to do, Marx and Adam Smith definitely agreed about that. They're manufactured by us, and we can change them, and we can invest them with the rules of the collective, the rules of the social construct. And, as others have talked about, Gillian Marcel, whom I see is on now, this isn't, it's not just about money. It's about really how money registers the behavior. It's about social capital. It's about knowledge capital. It's about, a variety of things about the way capital flows that have nothing to do with some sort of dollars and cents, narrow accounting. So anyway, yes, you can look at all of the other possibilities that emanate from having a baseline for certain kinds of enterprises. It's not the destination, but it's definitely a tool we need in order to figure out if we're having any making any progress. And the tools, the rules of the collective then are registered as goals and summative progress that come from the goals like the UN Sustainability Development Goals, carbon tax, what's happening in the US in terms of, is it lowering its carbon footprint? Is it expanding it? We all know the answer to that right now. But we can't have any agreements globally unless we have a way to measure whether what our individual and collective contribution is to meeting that goal. So I think I'll end there. I mean, that's really, the ESG is not the problem business as usual is. So there it is.
Thank you, Clara. I thought you brought up a very good point about this concept of social extraction.
Yeah.
So if that could be a guide for ESG measurement, how would you consider measuring social extraction?
Well, I think, there's been various, you start with, we had a saying at Heron, I think I said it earlier, which was no numbers without stories, no stories without numbers. And I think that figuring out what numbers mean with respect to social extraction, telling the story of that, and then going back to the numbers again is a perfect example. If you, yes, you have hired a lot of people of color. Well, then, what are they being paid? Where are they coming from? What are they doing? There's a whole story that's about, is this socially additive or is this socially extractive? So you can have that number. You can have the number of people you've hired. And you need to look at, are you paying them a living wage? There's a bunch of numbers you can put together, but then you start the story. Where are they? Are they in an abandoned labor market? So this is the only job. I mean, there are a lot of stories out there to tell, but I do think that having an aspirational, numbers have to do with helping us meet our aspirations. That's one of the uses of numbers. I realize they're used as a whip sometimes, as something to hurt people. But to me, they're a way for all of us to move toward a shared goal and meet our aspirations. And if we don't have them, it's just a little loose talk. We're doing such wonderful work. Well, actually, what are the unintended negative consequences of doing this wonderful work? If you look at a whole enterprise, yes, Tesla is doing good things about decarbonization, but gosh, those batteries are kind of, they're kind of environmentally icky. So, there's a net measurement, and we all have to be paying attention to that.
When I started 25 years ago trying to change the financial system, and I was kind of excited, okay, let's get people bought into ESG and impact. But it seems that when the big boys started to jump on board because they could sell ETFs or other things, they chose the lowest common denominator, almost like, I use the analogy, they want to show their membership card to the fitness club, but never go on the exercise machine or ever go to the club. So you people want more capital going in, but the result is the lowest common denominator. How do we get investors to embrace the highest common denominator?
Well, it would be helpful if, at the gym, people had to actually get on the exercise machine and it was shown that they had or hadn't. That's what actual accounting does for you. That's what actually, having rules of engagement does for you. When they got, I wrote this piece for Impact Alpha way back, I don't know, maybe 2017, something like that, 2017, I think. And it was about, the big guys are starting to come into the pool. It was a pool analogy. And, and they're doing cannonballs off the high dive. and we little guys who are down here who have done all this, very refined, talking about whether it's impact or not and all this stuff. Well, we're terrified and did we want success or actually this should be good? But the field wasn't ready. The field didn't have anything to say, if you're not reporting to the SEC or if you're not reporting to your investors using these baseline data that makes you comparable to your peers, that makes you comparable, in fact, to enterprises, that we're playing around with, you're not on the radar. You're not doing your job. You need to, and if you have that kind of data, you can be audited. That's the other thing. So somebody can go in and say, really, is that their carbon number? They look like they have a great carbon, here's XYZ auto company and they're being compared with Ford and GM and they have an outlier. Let's look at that. Let's get the story. Are they really an outlier and people should be throwing capital at them? Or are they actually, using some sort of made up data thing? So they can be audited if they're using the data standards. No wonder companies don't like that. We wouldn't either. It's painful, but it's good for the market, and it's good for markets.
You can measure CO2 reduction or growth or energy or water. So it seems a bit easier on the environmental impact. How do you measure the well-being of a workplace? Is it a toxic environment? I have a friend, I'm not going to name the name of the bank, and she's been working there a long time. And I warned her, don't go working there. You're going to hate it. They're going to treat you like dirt. And of course, she goes treated like dirt. I mean, it was a really toxic environment. But this brand of the bank is, wow, they're a superstar in sustainability. So something's a mismatch here. How do you actually try to capture and measure the social performance of a company?
Well, there's more than one dimension. I mean, I think there are the stories, and then there's the numbers, and and there's also the yodeling, which is, everybody is, all these, people are making commitments of whatever it is, $130 trillion, or, we are going to wipe out, Black poverty in America. And, I mean, this is and, it's having the stories, and the press is an important ally, I think, where Jamie Dimon gets up and talks about JP Morgan Chase and how we're providing all this money for mortgages and blah 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 blah, and on and on. And in fact, they're also providing much more money to the largest acquirer of owned properties, who are flipping them and turning them into rental homes and that private equity fund owns this, what's it called? Something like Welcoming Homes, or some euphemistic name like that. They're becoming the biggest absentee landlord in the U.S. and maybe the world. So yes, JP Morgan is also financing lots of anti-climate change stuff, and are not pro-climate change. I mean, they're financing carbon projects. All the big banks are. So that's, that's all about regulation, I think. This can't happen without good regulations. And, it's not just going to happen because of investors, I'm sad to say. Although,
do you see? I mean, we see press releases from the SEC of looking at ESG. Do you see some large, influential governing body like the SEC saying we are going to create accounting standards, and Clara Miller is going to be setting up and running that department? So get ready.
Talk about a toxic work environment. I don't know. I mean, I think, I think the SEC is just saying we're going to have accounting standards for these things. That's all it's saying. They're already material. They're reportable. And, I think it's at least half, maybe it's now over half of the S&P 1200 or whatever number it is, are already using SASB standards to report. It's just the ones that don't want to that we need to get to report. So, and it's private equity owned companies too, private companies also. So there's lots of work to do. But, I think that if there were a carbon tax, these are things the U.S. Congress has to do. I don't think they're administrative procedures. And, have we met the U.S. Congress lately? I think we have to put our hope in some other institutional presence. But it is at the institutional. It's at the institutional level, and I did a talk at the at the New York Fed yesterday or the day before, and it was about changing the plumbing. It's about the little rules and the little things that, fiduciary duty. Why isn't this about actually beneficiary risk, broadly construed. If you're a fiduciary, that is what fiduciary duty is. So who are the beneficiaries, and what is the risk of climate kind of wiping out their lives? Well, if you're a foundation and you're not looking at beneficiary risk, I think you're not doing your job. I think you're in breach of your fiduciary responsibility. And I think that's true of a lot of institutions. But, I'm not sure I'm answering. I'm sure I'm not answering your question because, gosh.
No, we're getting there. I mean, Freshfield's report came out a long time ago talking about fiduciaries have to look at extra financial issues and risk, or they are not fulfilling their fiduciary duty. So that was from at that time, the largest law firm in the world. But what happened to it? What happened to the Freshfields report and the impact on the industry?
Look, did people who gave their money to Bernie Madoff get penalized in any way? I mean, at the time that Heron did 100% for mission, there were all these, people were saying, "Oh, Clara's going to get taken off in chains," and I thought the dramatic possibilities of that were great. I thought, wow, this could be fun, but sadly, it never happened. In fact, our law firm, which was Milbank Tweed, thought it was of course you want to take into account beneficiary risk. Why is that such a big deal? Of course you can do 100% for mission. You can actually lend your entire portfolio. It's fine. Directly, if that's what we wanted to do. We had to make sure we complied with tax rules, but that's the same for any business. So what's the big deal?
Do you think the money invested or donated to lobbying and paying taxes should be part of the equation in determining the ESG performance of a company?
Yeah, I think that's a terrific number. Why not include it? It's a very good number to rate companies on. I think there's all sorts of, you can go nuts on data. And I think that it only goes so far. It's a starter to a bigger conversation. Why did you emit more carbon last year than this year, or last quarter than this quarter? Let's have a conversation about that. Let's have a conversation about how that gets better. Are you let's see why you laid off all those workers last quarter. I mean, that was one of the things that we looked at Heron, because we thought the jobs were good for people. It was a wild idea. And it was better to be employed than not, and maybe better to have a good job than a crappy job, better to have benefits than not, get benefits and opportunity than not. But anyway, you have to take the first step. But these are, companies might lay off workers because they have to live to fight another day. They'll go out of business if they don't. There was some, huge event that made it necessary. So I think it's a more complicated process, but it's not a process that having, measure your own. When I was 5 years old, I couldn't find somebody to play with out in my yard. I used to race myself, and I always won. And that's what's happening with a lot of companies. If they can make up their own numbers, they always win. It's amazing. We are, you look at CoreCivic, which is the largest private prison system in the US, and it looks like a social service agency. Until you start looking at its financial statements. But anyway.
Michael wants to know, do you think that the SDGs have any role to play in the reporting of companies?
I mean, I think that the SDGs are a perfect example of a collective goal. And I think they're a great focus point for companies in looking at themselves and whether their operations are actually contributing to that goal or detracting from that goal. So yes, I think that, once you get the data and you have data that's reasonable, and companies are perfectly, it's completely fine for them to say, actually, we've added something we think is material, or we added something we just think is important, and starting to report on that. And it may have a direct impact on an SDG. We are now providing educational benefits to all of our workers or something like that. But I think that imagining that one company alone is moving the needle on the SDGs, it is a collective process. It's how do we make it so we all together are contributing to that goal. It's also, it was interesting when we were looking at companies in Heron, and we said, well, who's the best employer now, even given flawed data in the US? Well, that company happened to be ExxonMobil. And it's because they have to have great training. They have to keep workers on those stupid oil rigs. Who wants to work there? There's all sorts of things that contribute to that number. But that's only, you can't take that away from the fact that they also have stranded assets underground, and they're also contributing to climate change. And so thinking that there's a magic number that says this is a good company and this is a bad company I think it's a fool's errand.
And to continue that train of thought of the SDGs, I'm at a conference in Oslo, and there was a Nordic private equity firm, very big one, 70 billion in assets, private equity, and they started to rank their companies according to which SDG they were addressing. So I said, wow, that's cool. Very simple, a spreadsheet and the SDG, until I actually looked at the company that they were claiming. So there was one, Zero Hunger. So I looked at what the company does. We make food coloring. We no poverty. Oh, what does that do? Oh, they provide mortgages to middle-class Swedish families. Interesting way of exaggerating that. Or another company was doing compression and gases for the oil and gas sector and claiming that they were creating a healthy community. So you can have the SDGs and just, wrap it.
Great. It provides focus, but somebody, you don't get to say whether you're meeting the SDGs or not. It has to be somebody outside the company comparing you to peers, comparing you to what's happened in your geographic area as a whole, comparing that, it's analysis. And I think one of the things that happens in the field a lot is that numbers, data and analysis get conflated, and then ratings. And they're actually very specific, discrete undertakings. You can't do good analysis unless you have comparable, kind of data that everybody agrees on. Then you do analysis and you come up with, are they meeting the SDGs? But it's not somebody only inside the company. The audit and assurance function is hugely important. This is accounting is destiny was another one of our war cries at Heron. And, it's important to actually look at your numbers, even if you don't like what they say.
Carrie had a question. She was asking, company in EU had established integrated accounting, which was adopted years ago, but still not moving system. Now people are going back to seeing if they can make this integrated model even better. What are your thoughts? Is anything going to work to move financial markets? Is it this combination, or is it about changing leadership values?
Yes, I would say, both of those things. I mean, you're putting your finger on all these kind of pieces of the puzzle that need to change and will hopefully start to move in the same direction. But we can't pretend that there's a, one thing that's going to magnetize the markets toward whatever it is, because people are people. This is a social construct. We have to decide we want to change the rules, and then we have to, live by them. And that's painful, because a lot of people who have a big vested interest in not changing have to be persuaded, or have to somehow be taken away from their delusion about the future.
Elsie wanted to know, what's the incentive for the enterprise to do as you suggest, tell the stories that are the proof points of their numbers?
Well, I think that well-managed enterprises who are managed for the long term in a decent business are the winners. And they are almost, and there are various kinds of business models, some of which actually are rewarding, kind of, I don't know, truth telling, I guess is the word for it. But I don't think there's a business that does very well for very long that is lying to itself. And I also think I will go back to we also have to change the bigger systems of taxation, of regulation, of all of those things. But each one of the things you're talking about is important. And I think companies that are in it, that then turns into, if you're managing for the long term, you're worried about climate risk. If you're an insurance company and you're not factoring in climate risk in your business right now, you deserve to go out of business, and you will. It's just not happening fast enough. So hopefully investors can put a little bit of moxie, the engine number ones, hopefully, there are various market forces that could be summoned. We just have to make sure they happen. And, it's both and, it's everything. It's throwing everything at it.
Melanie wanted to know, should we penalize companies or investors ESG-wise for involvement with stock buybacks, given that they deplete cash and create debt and costs that are externalized to society and the environment?
Yeah, well, if they're doing that, yes. I mean, but I'm not so omniscient personally that I could say every stock buyback is a bad thing. It just seems to me, as just a person, that it seems like an opportunity missed, when in fact, if you have that kind of profitability and you have that kind of retained earnings and capital within your business, you should be changing your business model so that it's regenerative, in the words of Paul Hawkins and others, so that it is actually contributing to the greater good in some way, and working toward that as a corporate goal. What an interesting, smart, good engine of change that is. And if I were an investor, I'd want to invest in those companies more than an investor in my pension fund, which...
Yanglo went a bit further with the stock buybacks. He's asking, might stock buybacks be just a consequence of zero interest rate policy? Once there is a real cost of capital, many stock buybacks become financially non-viable.
Yeah, good point. Really good point. If there are these short term, I'm talking this long term, flowery, we're going to go for the future. Actually, the things that make a difference to people in their lives are these little teeny, or these environmental aspects of those changes.
Giselle, actually giving you a shout out. Clara is one of the few people willing to be vocal about discomfort, and she stepped out from her own pack, which is very, very true. Don't you feel isolated because you're shouting your barbaric yawp and you're not going to be able to hang out with the cool kids at the school?
Well, that happened a long time ago. philanthropy people, it's like, oh God, everybody pretended to be friendly, but yeah, no, not everybody really was. But I don't, I'm past caring at this point. I'm, as a friend, as one of my colleagues from long ago used to say, I'm getting enough love at home.
But does it? I mean, calling, the industry, the players, and telling them, sorry, your children are ugly. Does it help?
How did you know
Does
about that?
does it get through to them? I mean,
no. I mean, that's the other thing. It's kind of like I'm the mad woman of Shalott. Do I think Jamie Dimon is getting worked up because and Clara Miller said the worst thing about me? I'm sure he has a lot of people saying nasty things about him, or even just true things that he can't deal with. Everybody, this is the world we're in. There's not a lot of conversation. There's a whole lot of yodeling. And that includes some really bad players, and it includes me. I try to have as many conversations where I'm in a, back and forth with people. That's what the real town square is. It's not everybody going down into the middle of town and screaming at the top of their lungs, no matter what anybody thinks. But that's basically what Twitter is. So that's about business model, but it's also about making the best of where we are.
Do you think that the ESG often is focused a lot in the liquid space because it's such a big market, the stocks and bonds? But do you think that the focus should be more on the illiquid space because of the potential impact for restoring the environmental and social balance? Do you think there's a greater chance there than in the listed market?
I think that is a huge opportunity, and it's definitely I can't say I have great ideas about that, but the peat bogs in the Congo, keep them in place. How do we engineer financing that makes that not only viable, but basically something everybody wants all at once, given our system?
I met I spoke to a gentleman in the U.S. I never heard of this model, but maybe you can clarify because I thought it wasn't possible. So he works with nonprofit, wealthy families who have philanthropic money, and he creates a vehicle, but they invest in for-profit entities through this vehicle. But it's nonprofit, it's charitable donations, almost like a donor-advised fund, which that's kind of interesting.
Well, that's what in a way, that's what a foundation is, right? It's got 100% of its assets go into conventional risk, low risk, high return investments, no matter what they mean to the supposed mission of the foundation. That's why the fiduciary duty thing is such a thing for me. And then 5% of the asset value in cash flow goes out in administrative expenses and grants to the mission. Talk about a suboptimal business model. This is ridiculous, but it sounds like that's what a foundation does. And that's what it takes a big contribution, it invests it conventionally, and then the cash flow, and that's sort of what a lot of family offices do, I think. They have a philanthropy over here. We do a little giving over here, but basically we're about wealth preservation for the long term.
But that seems to be still the 5% Andrew Carnegie model of we take all of our money, we put it in toxic waste, and we give away 5% because of which is subsidized by taxpayers for that 5%.
Oh,
and you
yeah,
can put your name on the building. So it's not you're right, it's not a very efficient use of money, but it does allow people to cut ribbons
Oh yeah,
rather
no,
than
yeah, no. It is
rather
very.
than
It's a lot of it's about ego. Build a building. Well, I don't know. But at the same time, I mean, everybody's sort of putting all this stuff on philanthropy. And if you take all of the endowments of big and small foundations, all of it, which is just shy of, let's say, $1 trillion in the United States, it's something like 14 months of the K through 12 public school budget in the US. You spend that all in 1 year or 2 years, even 5 years, it's just gone. So investing it, I think, is a very efficient use of funds. But the question is, to what end and in what and why, and how do you invest in a way that fulfills your fiduciary responsibility of benefits to the people you say you want to have benefits for? And when you're investing in, tar sands, shale projects, things like that, and then making grants for environmental, groups to do something that, I mean, it's just a lobby in Washington or something. It's ridiculous. It's wrong.
Are you still invited by other endowments to speak to them about how should we integrate our money into align that with our mission, or is it just no, this is how it is and they're never really going to change?
No, I'm invited to speak to them, and there are other people too. I mean, Heron's not the only one anymore. I mean, it's very, very, very slow progress, but there are other folks who were early alongside Heron, and then who are popping up now and trying to do this. But I think that one of the things that I wrote about in Trouble in Paradigm, that in the Nonprofit Quarterly, was the fact that there's an entrenched, especially in the large institutional foundations, entrenched in the business model, is that the investment function is separate and apart from the foundation as a whole and its mission. And it's the person who is the chief investment officer gets on average 2.5 to 3 times what the president gets. That's Ford. Their compensation is based solely on financial return. It could be based on a broader set of issues. And it's about staying in a conventional place with conventional relationships. And that makes it really hard to change. It's starting to, but you need to get the entire board, everybody involved, and not leave the investment function to the professionals, the quote professionals, because that's what will happen. Feathering that nest is a very, very circumscribed undertaking for them. It's hard enough to make 5% real. I don't know how many times I've heard that. And that's not, that's something for the board of the foundation to stand up on its hind legs. Very few of them are willing to do that. So I'll come in and talk, and everybody will listen very nicely and go out and do precisely what they want, of course, which is what the chief investment officer wants.
Melanie wanted to know, how do we get large LPs like pension funds to support the smaller, socially friendly, non-traditional fund managers like Moxie, like Engine Number One? Even Engine Number One currently has to fight against the large LP, conservative culture, diversification rules, perception of risk, which makes it hard for them to get assets under management. How do you think we should change this, or could change?
I don't know. I mean, that's a great question. I think maybe reinventing an enterprise, maybe a group of high net worth individuals get together and create a separate table or a separate framework that is long-term, a holding company, something like that, that makes it possible for those kinds of enterprises to thrive in that situation. But it's a culture that's real hard. It might have to be reinvented entirely.
What can the audience that's listening live and those that will watch the replay do to help you?
Who? Gosh, I think really have boards of directors look seriously at their fiduciary duty to future generations in particular. That will focus the mind. The only endowment we all have is nature and ourselves and our connection to each other. That is our endowment. It is not a little pot of money or even a big pot of money. That's kind of a will o' the wisp. It's just a social way of storing information, right? So I would say that. I would say don't fool yourself about perpetuity. Nothing is right now, the idea of this formula for perpetuity in the condition the world is in now is a fool's vain hope. That's what I think. And boards of directors are the ones who have that in their power to change the conversation at the enterprise level. In investment enterprises, whether you're a fiduciary, whether you're an advisor, whether you're a foundation or a family office, it doesn't matter. That you need to change the nature of the plumbing. You need to change your idea of what fiduciary duty is, how money turns into mission. And that will help me and if I can help you do that, let me know.
Well, I mean, you're always a true, as my father used to say, a mensch. I ask you what could do to help you, and you just give all kinds of examples how to help something else. So thank you for that. Steve wanted to know what gives you hope, what keeps you going.
Well, I I think it's my grandmother. No, I will not become maudlin of this because it's very hard. Her basic thing was, just do something, and I feel like as a kid, our generation screwed up. That's what I think. I think all of us, had the absolute best possibility and all the tools, and we just frittered it away. And I still, therefore, I feel that I need to keep on keeping on. So that may not. There's this great quote from Desmond Tutu, which is, "I am not an optimist. I am a prisoner of hope." And so I would say I have hope because I'm a prisoner of hope. It's just in my somehow DNA.
I'll happily join you in that prison as an inmate. We're coming to the end. I'm going to take a group selfie if that's okay with everyone. Just wave to the camera and prove that you were here, and then we'll go right into the virtual mixer. So just wave and the camera will collate all the photos and we'll send that to you. And I will also send the replay to everyone. Clara, you've been spectacular. Even though I'm on the road, I want to thank our entire production crew, Sam, our producer, crypto genius, and ramen critic. Ricky, my absolute better half with no filter, Xi Jinping, our head of transparency and integrity, Vladimir Putin, our president of Mother Teresa School of Compassion, Elon Musk, our humility coach, and Sergei Lavrov, our fact checker extraordinaire. Thank you all very, very much. Stick around because I'm going to go right into the virtual mixer. I'll send everyone after this in an hour or so the replay so you can watch it over and over again and get these incredible inspiration. Clara, I'm happy to be in jail with you as a prisoner of conscience. So thank you. So I'm going to end this here. And yes, and now we're going to go right into the mixer. So just stick around. Okay, let's see this. Okay. Here we go. Enjoy the party.